The election has been had and the U.S. has chosen. Now what? That's the question that we're going to grapple with here on Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And what we are going to consider here is, of course, the next big thing on the calendar for this week after this tremendous volatility that we've seen in the wake of the U.S. presidential election, and that is the Federal Reserve monetary policy announcement. That comes at us in less than 24 hours here. And so what we're going to do is to take a look at, of course, what the markets did in the wake of the election, how that positions them going forward, and then consider what is the influence that the Fed might have in this context. So let's break this down here. This is the performance across financial markets in the wake of the election. We can see clearly here strong gains for both stocks and for the US dollar and for Bitcoin. So interesting set of circumstances here. Stocks roaring higher, up nearly 3% on both the benchmark S&P 500 and the tech tilted NASDAQ here. The performance in the small cap Russell that we don't have on the screen here, even more dramatic, a gain of close to 5% there. Interestingly, also yields powering higher, a very sharp rise, in particular at the long end, 3.88% increase in the 10-year, almost a 2.5% rise in the 2-year, a steepening of the yield curve, of course, because the long end gains more here than does the front end. Crude oil, basically a goose egg. I suppose that shouldn't be surprising. Both the outgoing administration and now the incoming Trump administration seem to be minded to producing oil at maximum capacity. The U.S. is already the world's biggest petroleum producer, creating more than the output of Saudi Arabia and Russia combined now, today. So perhaps this wasn't the place to see meaningful impact. Gold down sharply with that rise in yields off almost 3%. And the dollar running roughshod against all of the major currencies, up nearly 2% against the euro and yen. Dramatic gains all across the board for major currencies. And this is where things get interesting. Now, obviously, unless you've been living under a rock, you know that the outcome of the U.S. presidential election was a resounding victory for former Republican president and now third-time nominee Donald Trump. He wins not only the Electoral College, but also the popular vote by a significant margin and has a clear mandate. This, of course, means that any possibility that, like 2020, there would be some sort of a contesting of the election, or that there would be some kind of prolonged uncertainty after the outcome, that seems to be off the table. And with that, at least part of the market's exuberance seems to make sense. Markets hate uncertainty more than they hate any one thing or another. Any outcome can be benchmarked around. It's the uncertainty of outcome that markets absolutely despise. And so when we have certainty and a clear result, we can move on. There is a significant reason for markets to cheer just in that realization. Then, of course, there is the platform itself. And here is where the interesting dichotomy between what this performance suggests about stocks and bonds, this is where it comes into play. On the one hand, and this is a script from 2016 when Mr. Trump won the first time, there is the prospect of deregulation. There is the prospect of tax cuts, especially corporate tax cuts. There is the prospect of some sort of a peace dividend to be had from hard-nosed realpolitik deal-making, whereby perhaps some sacred cows might be slaughtered, but a de-escalation, at least, as it were, in one theater of war or another that currently still fester, one in the Russia-Ukraine theater, the other in the Israel and Lebanon/Gaza theater, the Israel-Iran theater by proxy, as it were. At least one of these theaters might see a significant de-escalation. And so with that in mind, you see a positive response for stocks as well. The flip side is you likewise see expectations for runaway inflation. As you get a surge in rates and you get a surge in the dollar on the expectation that the Fed will be hobbled in its ability to cut interest rates because things like deglobalization, things like tariffs, and things like tax cuts that grow the deficit, all of that portends faster price growth. All of that portends inflation. And it is with that in mind that we look ahead to a Federal Reserve meeting where the central bank will have to contend with all these things and see how they might offer their 2 cents into this narrative and change it. The expectation is at this point ironclad that another rate cut is coming. This would be in line with what the Fed signaled to the markets in September. The probability of the cut at 99%, looking at Fed funds futures. So it's seemingly straightforward and clear cut that the Fed is going to deliver this move. And moreover, if the Fed does not deliver the move, the dislocation in markets might be so aggressive that the Fed could be inspired to do what it feels it needs to do to maintain stability, other considerations notwithstanding. Then things start to get a little different. Looking at the probabilities for the last meeting of the year, December, we see that the likelihood for a follow-on cut has come down to just 70%. That's a significant departure from the nearly 80% that were expected just yesterday. And of course, the Fed, when it announced its policy intentions, or at least penciled in its policy intentions mid-September with its forecasting, it said 100 basis points in 2024, and here's 50 up front. That meant another cut in November, that's tomorrow, and another one in December. That fourth cut is now somewhat in question. Moreover, the Fed signaled 100 basis points in cuts for 2025. That too is now in question. In fact, we can see here that expectations for this year and next have significantly shifted since the Fed made that initial 50 basis point move in the middle of September. We can see U.S. economic data improving has actually driven a hawkish rethink that's already been ongoing well before the election. The outlook for this year seems relatively steady. Minus 33 basis points here speaks to one cut. That's the one that's ostensibly on the menu with near perfect certainty tomorrow. And then some probability for a second, but clearly diminished relative to the kind of certainty that was had in the immediate aftermath of the Fed's move. So if we then consider that only about 8 basis points of that second cut is actually priced in, then there's only a 32% chance that it will occur. Next year, the outlook is significantly diminished, only 59, let's call it 60 basis points for next year. That's 2 cuts and maybe the slight possibility of a third. That's a far cry from the market's 5 cuts that they had on the menu after the Fed made the initial move right here. And of course, likewise, a far cry from the 100 basis points that the Fed itself envisioned. All this election has done in its repositioning to a higher dollar and higher yields is continue to build in this direction. But it's a move that's been ongoing already. And as we said, it is thanks to US economic outperformance that this rethink has occurred. Now, the Fed, with this policy announcement, seemingly has a rate decision that is a fait accompli. But the signaling may well give something market moving. If the Fed uses the policy statement with this announcement, as well as the press conference with Fed Chair Jerome Powell after the meeting, to modify its language and say, just in case the markets were confused, we are not on autopilot. We are not locked into rate cuts just because we said that we thought they were likely on the menu back in September. That we are seeing inflation numbers stall on their way lower, which we've now seen in the PCE numbers, which we've seen in the CPI numbers, especially at the core. If inflation expectations are surging, we don't necessarily need to cut. We are not going to let inflation out of the bag. And the markets need to be ready for us being a central bank that decides things still on a case-by-case basis, not on a predetermined course. With that in mind, the Fed may well signal something that triggers a further melt-up in yields, a further melt-up in the US dollar. And the question then, of course, is, can stock markets' vigor withstand more upside here in context? And that is, of course, because if we consider the global picture, discussed this yesterday, and if you're watching on YouTube, I'll provide a link just above my head here to that conversation. But the global economy is primarily powered by 3 main engines. The US is the largest, and then there is the Eurozone and China, and the rest of the world, about 42% of global GDP, are largely vendors to the former 3 that depend on demand from the former 3 to have growth of their own. So consider Canada and Mexico with the US. Consider Central and Eastern Europe, even Nordic Europe with the Eurozone. Consider Australia, New Zealand, Southeast Asia, the commodity exporting parts of Latin America and Africa for China. The story in the US, as we can see from this economic data performance here, is clearly one of robust positivity. In fact, we just got evidence of that again this week as we got blisteringly hot ISM service sector data showing that the largest component of the US economy, its largest growth engine, is expanding at the fastest rate since August 2022. So the US economy is absolutely racing forward. Hence the inflation expectations and the diminished rate cuts outlook even before the election. But when we look at the other major engines of global growth, the story is quite the opposite. We just got updates on Purchasing Manager Index data this week. We can see the US holding strong here, having hit a 12-month high back in May. But the situation for the euro area and for China, quite darker. For China, there's been the slight improvement that we've seen just over the past month, but the trajectory is clearly lower. We're barely above standstill. For the euro area, we've actually contracted for the past 2 months. The Latest PMI data showing 2 consecutive months that economic activity in the euro area actually fell. Those updates just coming across the wires this week, as a matter of fact. And so, with that in mind, we have a very different global growth situation than if these things were working in concert. Looking at composite global PMI numbers, we can see that actually global economic performance has been slowing since May, despite the fact that the US has been booming. And in fact, as of September, see what happens in October's numbers. Those are not out yet, but we can certainly see here that for September, global growth was the weakest since January, largely because of an anemic China and a fizzling recovery in Europe. Why is the strength in the world's largest economy, the US, not spilling over here? Because most of the spending is focused domestically. We can see, unpacking US inflation data here, that most inflation, and by extension, most demand, lives in core services. And most core service providers are domestic firms. So all of the US vigor that we see, almost all of it, speaks to robust demand for the wares of American service providers. And so the prosperity isn't spilling over. As we can see, core goods inflation is actually negative, implying demand is not just weak, but in year-on-year terms, down. And so we end up with a situation then where the US is in something of a bubble. In fact, if we look at the spread between the percentage point contributions to PCE, the Fed's favorite inflation gauge, from services and goods, and we look at the spread between the two, services now outstrips goods by the biggest margin in 2 decades. And that, of course, is a very toxic mix for the world economy, even as the US continues to power ahead, because the surge in yields that we have seen has been mirrored outside the US, despite the fact that outside of the US, the direction isn't to see reflation on the march. As a matter of fact, it's quite the opposite. This weakness that we're seeing in the global economy as a whole speaks to disinflation, speaks to the desire for lower interest rates to power through a downturn. But that isn't likely on the menu, despite what those central banks may want to do, because what we have is a world in which 88% of global monetary transactions are settled in US dollars. So if the Fed backs off rate cuts, and we continue to move in this direction, well, then the cost of borrowing is likely to rise for everyone, because if the cost of commercial activity is measured in dollars and the cost of borrowing dollars rises, well, then the cost of borrowing, full stop, is going to be higher. As a matter of fact, as a consequence of today's move, an average of bond yields outside of the US, looking at Germany as a proxy for the Eurozone, the UK, Australia, and Japan, that's jumped to the highest level since May. And of course, that's been mainly a consequence of US yields surging, not because of anything that happened in any of those economies. So if we look at a situation here where the global economy needs lower rates because of this disconnect, it's probably not going to get them. And that, of course, increases risks for some sort of an adverse economic outcome that invariably backfires on the US because the global economy is so interconnected. If there is, thanks to higher rates and already anemic conditions, a recession that hits the euro area and China and the remainder of the global pie that isn't the US. It seems very difficult to imagine that a quarter of global GDP will be absolutely impervious while 3/4 suffer. And therein lies the question for stock markets. Is it then still logical that stock markets expect Goldilocks going forward when clearly the last time that we had a reacceleration of US growth right here, we had a digestible readjustment lower in rate cut expectations, and that was because global growth was improving at the time. But we are in a different situation. So can stocks really hold these gains? That's a question that might be helped along by the Fed were it to adjust its language in a more hawkish direction. It might also be helped on by the Bank of England, which also has a policy meeting in the wake of the Fed tomorrow. They're expected to cut rates by 25 basis points. We can see that much is already almost fully priced into the market. And if we take a look at the pathway forward, we have perhaps another rate cut on the menu for December, though the likelihood, as with the US, is relatively low, and then a further 50 basis points in cuts next year. If the expectation now is that US yields are going to be much higher, but the rest of the global economy, including the UK, is on a very different and a much worse growth trajectory than is the US, well, then the guidance from the Bank of England might well be much more dovish and paint the way for many more rate cuts, in particular next year. That could be a preview of what many other central banks have to do to counter the rise, or try to counter the rise in borrowing costs thanks to an inflationary US economy that then ties the Fed's hands. In practical terms, this, of course, speaks directly to what's going on in the British pound. It was rejected sharply lower as the dollar gained following Trump's victory. The critical support here now right at 128.33 to about the 129 figure. That's this band right here. We're sitting right on the swing lows. If we get a dovish Bank of England, the immediate result might be a push through this area down into the mid 126 zone, give us the next big leg lower. And of course, a question and a dark cloud will loom over stock markets to see just when are they prepared to think about the idea that all of this reflationary dynamic and its Fed consequences will throw a grenade on global growth. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'll be back in a mere 30 minutes after this show, as I am every Wednesday for The Price of Truth with Victor Jones. Back on with Chris for Futures Power Hour on Friday and the subsequent Monday. Back with Victor and Tom for First Call on Sundays. Writing for the News and Insights portion of tastylive.com and commenting on the platform formerly known as Twitter at Ilya Spivak. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow.